Picture this. The news is glowing with headlines about record highs. Your neighbor is suddenly talking about stocks at the barbecue. Even the taxi driver has a can't-miss investment tip. Everything feels safe, like the market is unstoppable. But here's the strange part. History shows that these exact moments, when everyone feels most confident, often come right before things fall apart. Why does it work like that? Why does the peak of optimism so often mark the beginning of a crash? That's what we're going to explore today. The patterns that almost always show up before the market turns, and why we never seem to notice them until it's too late. If you look back at almost every major crash, there's this eerie calm right before it happens. The numbers look great, the charts are climbing, and most people believe the worst is behind them. Take the dot-com bubble, for example. In the late 1990s, the internet was the future, and everyone knew it. Companies with no profits, sometimes no real business model, were being valued higher than century-old firms. People would quit their jobs to day trade from their living rooms. The mood was electric. It felt safe. Then, almost overnight, the story changed. Stocks that people thought could only go up started free-falling. Within months, trillions of dollars had disappeared. And the same thing happened in 2008. Real estate prices kept climbing. Banks kept lending. And almost everyone believed housing could never fall nationwide. That phrase, never fall, was repeated so often it started to sound like a fact, until it wasn't. The first sign, almost every time, is euphoria. That sense that nothing can go wrong. Markets don't just climb, they soar. People stop asking hard questions. But here's the thing. Euphoria is only one of the signals. There's another warning sign that sits quietly in the background, harder to notice, but it shows up almost every single time. And when it does, it tells you the ground under the market isn't as solid as it looks. That second signal I hinted at, it's debt. When people and companies feel invincible, they borrow more. In the stock market, that shows up as margin debt. Investors borrowing money to buy even more shares. It works great when prices rise. But when they fall, the debt doesn't shrink. It grows heavier. That's exactly what happened before the crash of 1929, and again before 2008. Debt builds confidence on the way up, but magnifies panic on the way down. A third sign is media hype. When the evening news or lifestyle magazines start telling you which stocks to buy, that's usually a late-stage signal. In 1999, you'd see magazine covers with people who got rich overnight. In 2007, it was endless stories about flipping houses. When everyone's talking about easy money, history shows it usually doesn't last. Then there's strange market behavior. This one is tricky because on the surface, it looks like stability. Volatility, the day-to-day swings, tends to sink to record lows right before things break. Investors relax. They think the market is calm because it's healthy. But in reality, that calm often means risks are being ignored or hidden. It's like the silence in a forest just before the storm hits. And finally, something more subtle. Liquidity starts to dry up. In simple terms, money that was easy to borrow suddenly becomes harder to get. Banks grow cautious. Interest rates creep up. On the surface, the market might still be setting records, but underneath, the gears start grinding. In 2007, interbank lending was already tightening months before most people realized there was a problem. Individually, these signs can be brushed off. Together, they form a pattern. And once that pattern is in place, the crash itself doesn't need a big reason. It only needs a trigger. But here's the twist. The trigger isn't what causes the crash. It only exposes the weakness that was already there. When all those signals line up, the euphoria, the debt, the media hype, the hidden stress, the market becomes fragile. At that point, it doesn't take much to start the fall. This is where the trigger comes in. People often blame the crash on the trigger, but history shows the trigger is never the true cause. Think about 2008. Many say the collapse of Lehman Brothers caused the financial crisis, but in reality, the crisis was already baked in. Bad loans, risky bets, too much leverage. Lehman was just the match. The gasoline had been spilled for years. The same with the dot-com bubble. The trigger was a few disappointing earnings reports, but the real problem was that valuations had been stretched far beyond reality. When the story cracked, panic spread. Here's the sequence. The warning signs build quietly in the background. A small shock, maybe a bank failure, maybe a policy change, sometimes even just a bad headline, hits the market. Confidence evaporates almost instantly, and then the selling begins. First, it's cautious, then it accelerates, and finally, it turns into outright panic. What was once considered a safe bet suddenly looks like a trap, and everyone tries to escape at the same time. That's the domino effect of a crash. It's not one big push. It's a chain reaction set up long before the first piece falls. But here's something worth remembering. These same signals that warn of danger can also hint at opportunity. Because when the dust settles, those who recognize the pattern often see the recovery before the rest. So what does all of this mean for you sitting here today? It means the goal isn't to predict the exact date of the next crash. Nobody can do that reliably. Instead, it's about noticing the patterns. When optimism feels endless, when debt is piling up, when headlines make investing sound effortless, those are moments to pause and pay closer attention. It doesn't mean run for the exits every time you see one of these signs, but it does mean understanding that markets move in cycles. The highs don't last forever, and neither do the lows. And here's something most people miss. The same signs that tell you a crash is coming also point to where the best opportunities will be once the panic passes. History shows that the seeds of the next rise are usually planted in the ashes of the last fall. The truth is, no two crashes look exactly the same, but they do rhyme. The calm before the storm, the buildup of risk, the sudden trigger, the chain reaction. It's a pattern as old as markets themselves. In the next video, we'll explore how some people didn't just survive past crashes, but actually came out stronger on the other side, and what we can learn from them. For now, I'd love to hear your thoughts. Which crash do you remember most vividly, and what did it feel like at the time? Share your story in the comments. It's always fascinating to see different perspectives, and if you found this video helpful, please give it your hype points. Share it with someone who would find it useful, and subscribe. It really helps the video so we can grow this channel together.